Hello, welcome to this discussion on monetary aggregates. What are we going to discuss today? Guys, have you ever thought if you deposit 1000 rupees into your bank account, how much does that money become? Does that remain 1000 rupees? Does that become more than 1000 rupees or does that become less than 1000 rupees? How is it that if today we go to collect all our money from all the banks will not have enough sufficient cash to return all of us? Why is it that if you would have heard something about measuring the money supply, why do we need 4 types of different measurements? What is the fractional reserve banking system? That is what we will learn today. Today we will learn how the economy works, how the banking system actually works. Let's start with the discussion. Now, today, the first thing that we'll see is how does the fractional reserve banking system work? Because this is the cause of why we have different monetary aggregates. And then obviously we will be solving certain questions. So, enough things said, let's start with the discussion of what exactly is this fractional reserve banking system. Now, what is the fractional reserve banking system? See, the name itself is telling you that the banking system is working on something reserves which is a fraction of something. So, let's try to understand this. For example, right now, the bank, if you deposit some money into the bank, the bank has to keep some part of that money with itself and it can loan the rest. Which is why some fraction of your deposits have to be kept in reserves with the bank so that the bank can honor withdrawals and other regulatory requirements, and the remaining it can lend. So, what we have said that fractional reserve banking system. What is the fractional reserve banking system? Under this system, banks can give loans from the deposits received as long as they keep a fraction of those reserves with themselves to meet withdrawal or regulatory compliance. So, what does that mean? Banks need to have a certain reserve ratio. And which is why every 100 rupees that gets deposited, if the reserve ratio is, let's say, 10%, banks need to keep 10% of 100 with themselves and they can give out the loan to others. So, for example, SBI will keep 10 rupees with itself and 90 rupees it can give loan to someone else, and this is what is the fractional reserve banking system. Now, let's try to discuss how does the modern monetary system work. Now, suppose one fine day you are cleaning your home along with your grandfather. And when you are cleaning your room along with your grandfather, what do? You come across a new 1000 rupee note lying somewhere. So what will you do? You would want to go out and spend that money onto certain goods and services, Domino's, pizza, movie. But what will your grandfather tell you to do? Your grandfather will tell you that you take this money and you go and deposit in the bank. And that is what happens. So when you found new money, when you found new rupees 1000, you go to the SBI and you deposit that money. Now the reserve ratio is how much? 10%, which is why SBI will take 10% of it, 100 rupees with itself, and it will give a loan of 900 rupees to another fellow, Sharma ji ka ladka. Now Sharma ji ka ladka is also very smart. So Sharma ji ka ladka will deposit this money with HDFC. Now HDFC also needs to keep reserve ratio of 10%. So HDFC will keep 10% of this 990 rupees with itself and it will give a loan of 810 rupees to Sharma ji ki ladki. Sharma ji ki ladki is even more smarter. She will go to a foreign bank and deposit 810 rupees. HSBC also needs to keep 10% of this and it will loan the remaining amount. And this is how the entire cycle will flow. This is how your 1000 rupees will float through the banking system. Now, there are 2 important questions that we need to understand. What are those 2 questions? First of all, how much money do these 3 people think that they have in their bank accounts? You think you have 1000 rupees. Sharma ji ka ladka thinks he has 900 rupees. And Sharma ji ki ladki thinks she has 810 rupees, which means all in all, the 3 of you think that you have 2710 rupees in the bank account. However, you think there are 2710 rupees in the bank account, but how much amount or how much cash is actually there in the system? We started with 1000 rupees and that is the only cash that has been introduced in the system so far, which means actual cash in the system is 1000 rupees, but the money that is in the system is 2710 rupees, which leaves me to 2 points. First, how did this extra money get generated and why and who created this amount? And by this example, you should know one thing, that cash is a subset of money. Cash does not equal to all money. Cash is a subset of money. Please keep that in mind. We'll circle to that point again in some time. However, by this you should know that cash is a subset of money and there are different types of money, which is why since there are different types of deposits, there will be different types of money and therefore different measurements to measure that money to get the money supply, which is why we are going to have M1, M2, M3 and M4. I hope this point is clear till here. Let's move ahead. 2 important questions again before we move forward. Number 1, where did this extra 1710 come from? And this leads us to an important question. Who creates money in an economy? Now, 2 entities create money in the economy. One is the government of India and the RBI by printing currency. This 1000 rupees. Who got that? RBI did that. So, this fellow, when you deposited the money, you were RBI. But after that, how did this extra 1710 get created? Banks created that by giving credit. So, in an economy, money, cash. Money is created by two entities, RBI and government who create cash and banks who give credit. I hope you got that point. Then, today if we go to withdraw our deposits, can the banks honor all our demands? No. Why? Because there is not enough cash in the system. And which is why you cannot withdraw from your account cash up to a certain point. Given all, you can go to all the bank branches, but you cannot withdraw beyond a particular amount, the cash, because there is not enough cash in the system. You can transfer money, but you cannot withdraw cash because cash versus money. Cash is a subset of money. Cash is a subset of money. And try to understand here, what have we done here? Money is a larger superset of that. Commodities can also act as money in medium of transaction of goods and services. Precious stones, metals, gold, that can also act as money because money is anything that helps in transaction of goods and services, and it has much other properties as well, but that is not the point of discussion today. Negotiable instruments, your check, DD, demand draft, all of them also act as money, but they are not cash. They are not cash. आप जो check लिखते हैं, the checks that you write, they are not cash. That is a type of money. That is a type of paper money. Digital money, the money that you transact through UPI, that is also a type of money, but that is not cash. That is not currency, which is what was the problem during the demonetization, is because we had made digital money de facto legal tender. We had made digital money to be accepted mandatorily for settlement of transactions. However, it is only paper currency currently that is the legal tender. Legal tender, what is a legal tender? A legal tender is that which is mandated to be accepted for settlement of transactions across the country. For example, rupee is the legal tender here. USD is a legal tender in US. Bitcoin is a legal tender in El Salvador. So, in all these countries, these respective legal tenders are mandatory to be accepted for the payment settlement. So, in India, cash is mandated, not digital money. Digital money is not a legal tender. By the way, have you heard of CBDC? Central Bank Digital Currency. What does CBDC do? CBDC converts a part of this digital money into legal tender. However, that is not the discussion for today, so we'll discuss that sometime else. But remember, this is also why we have CBDC, DC, digital currency. It makes a part of digital money as legal tender, cash. So CBDC will eventually be like cash in your pocket. Anyway, let's come back. Let's stick to M1, M2, M3, M4 because that is the discussion for the today. So all cash is money, but not all money is cash. Please remember that. Then moving on. So before we go ahead, two more concepts related to monetary aggregates. I hope you remember who creates money in an economy? RBI by printing cash and banks by giving credit. And there is not enough cash in the system to honor all our deposits, which is why even if one bank fails today, it poses a systematic risk to all the other banks. That is why when Yes Bank failed and its depositors wanted to withdraw cash, RBI had to step in and assure the depositors that your money is safe. Because if all of them all went to Yes Bank to withdraw cash, there is not enough money and the entire banking system would have collapsed. Because where will the cash come from? From other banks, and then they will face cash crunch. And to protect that, RBI would have had to print more money and more money would have gotten created, leading to inflationary problems. Anyway, let's come back. Two more concepts before we go. So one is the type of deposits. Whatever deposits you make in an economy or in any bank or in any financial institution, they can be of two types. One is time deposits and the other is demand deposits. What are demand deposits? Savings or current account. Demand deposits are those deposits which need to be given to you as and when you make demand. When you make demand to withdraw 10,000 rupees from your savings account, bank has to honor that demand. Banks have to honor that demand. Banks cannot go back on their promise. Similarly for the current account as well. Then time deposit, fixed deposit and recurring deposit. Fixed deposit, you have given it for a fixed time. You've already given it for a fixed time to the bank. Bank is not obliged to give you as soon as you make a withdrawal request. It is good customer service to make those funds available to you after charging you a little penalty, but it is not mandatory. It is not a legal obligation. It is service orientation. I hope you got the point. So there are two types of deposits, time deposits and demand deposits. Now, another concept is what is meant by the statement. What is meant by the statement? Money with the creators of currency is excluded from the scope of public. Which means all the money that is with the government of India and RBI is not included in the calculation of money supply. What do we mean by this statement? See, public. What essentially is public? You and I are public. Corporates are public. But the creators of currency are not in the definition of public, which is why when RBI swipes up some money from the market with itself, that money is still there. But that is assumed that money supply has decreased. If RBI takes some money from the banks, it is assumed that the money supply has decreased because RBI is not within the definition of public. What is public? You and I, corporates, banks. By the way, how come banks are included within the definition of public? How come banks are getting included within the definition of public? Public excludes creators of currency. Bank create money. Currency or cash is created by Government of India or RBI. That is why when we will see M1, M2, M3, M4, whenever you would have read about it, any money with RBI or Government of India is excluded. That is why National Savings Certificate is excluded. Why? Because who has that money? Government has that money, and government is a creator of currency. That is why it is not considered the money with public. That is why deposits or bank deposits, repo rate, reverse repo rate, all this money, whenever RBI takes money from the banks under reverse repo rate or VRRR, variable reverse repo rate, that money is assumed to be not present with the public because RBI is not within the definition of public. I hope you got that point. With that said, now let's talk about what are the monetary aggregates. Now, what are the monetary aggregates? M0. This is called as high-powered money, which is the 1000 rupees. This M0 is the 1000 rupees that we got. This is the monetary base of the economy. This is the monetary base of the economy. So let's try to understand the other one. Then there is something called as M1. What is M1? Currency in circulation with public, which means currency that the RBI has printed but kept with itself does not increase money supply. The currency that RBI has printed and the government keeps with itself does not increase money supply. However, it is assumed that when they print, it is also assumed that they have spent it. That is why it is assumed that when they spend it actually, it is only then that the money supply increases. I hope that is clear. Which is why if government will take some money from you, National Small Savings Certificate or even PF contributions, when you have given that money to the government, that will be excluded from the definition of public. I hope that is clear. Then demand deposits of public with banks, which means any money that is of the government with the banks will not be included within the demand deposits of government with the bank. So this is CC plus DD and this is OD. Just now we learned that any deposit with RBI will not be considered as a part of money supply. Then how is it that we are including other deposits with RBI? What are these other deposits? These other deposits are those deposits which are in other currency. IMF, dollar, World Bank, ADB, all these banks give us money in dollar. RBI is the creator of rupee, not dollar. RBI is the creator of rupee, not dollar. That is why those money or that money will also be included in the money supply. And that is how we get the equation CC plus DD plus OD. Now see, here I have given it to you how you can learn the other aspects. So M1 is, M2 is M1 plus PD. PD is what? Post office deposits. M3 is M1 plus TD. TD is what? Time deposits. And M4 is M1 plus TD plus PD. But there is an easy way of learning it. What is that easy way? Remember when you were in school, you were always faced with that PT teacher. The PT teacher is not a human. It is an organism. It exists. It exhibits same qualities across all the schools in India. Every PT teacher will have the same qualities across all the schools in India. Bad English and always scolding. Always. So PT teacher, sometimes we used to get very angry on the PT teacher. Sometimes we used to get very angry on the PT teacher. मन करता था उल्टा लटका के मारे. Hang them upside down and then take revenge. Hang them upside down and take revenge. That PT teacher will help us in learning this concept. How? This is PD, TD, TD and PD. That PT teacher will help us in learning this. How? PT, TP, PD, TD, PD, PD. These are post office deposits, these are time deposits. M1 plus PD is M2. M1 plus PD is M2. M3 is M1 plus PD, M1 plus TD. M4 is M1 plus PD plus TD. M4 is M1 plus TD plus PD. TD plus PD. This is how you will remember this. I hope it was clear till here. Next, let's try to solve a question. So, for example, this is the UPSC question. If you withdraw 1000 rupees from your savings account, what is the immediate impact on aggregate money supply? What is aggregate money supply? M3. What is the aggregate money supply? M3. 3. So what will be the impact of this on money supply? Will it increase by 1000? Will it decrease by 1000 since we have taken the money out? Will it increase by more than 1000? Why? Because we know about money multiplier. We know about money multiplier. What is the money multiplier as of now, by the way? 25 July. What is the money multiplier? Currently, the money multiplier is 5, which means every 1000 rupees that you deposit become 5000 rupees through the entire banking system. In our case, it was 2.7. Why? Because every 1000 rupees you deposit were becoming 2710 rupees. I hope this is clear till here. So, does it increase by more than 1000 or does it remain unchanged? I'll give you 10 seconds to figure it out. Then, let's try to see. Will it increase, will it decrease, or will it remain same? Chalo, let's try to figure it out. So, what is M3? M3 is M1 plus TD. M3 is M1 plus TD. What is M1? CC plus DD plus OD plus TD. This is the formula. Now what has happened? You have withdrawn 1000 rupees from your savings account, which means plus DD minus 1000 rupees plus OD plus TD. However, this 1000 rupees have gone to where? This 1000 rupees have immediately gone into your pocket, which is why your CC becomes increased by 1000 rupees. When you will open it, what does it become? It becomes CC plus 1000 rupees plus DD minus 1000 rupees plus OD plus TD. This gets cancelled. So, the money supply remains unchanged. I hope this is clear, guys. Alright, let's look at a few more questions. Let's try to look at a few more questions. So, with respect to the Reserve Bank of India, this is an easy question. What constitutes M1? We know M1 is CC plus DD plus OD, and that is currency with the public plus demand deposit with the banks and other deposits with RBI. Then try to solve this question, guys. Which of the following statements are correct with respect to the fractional reserve banking system in India? A fall in reserve cash reserve ratio raises theoretical money multiplier, other things remaining unchanged. Is this right or wrong? Now, what is the reserve ratio? Remember what we had kept as 10% in the example. What is the reserve ratio in India? Reserve ratio is CRR plus SLR. Reserve ratio is CRR plus SLR, and that is also why money multiplier is inversely proportional to reserve ratio. Imagine yourself, if 10% was increased, in our example, if 10% was increased, the money multiplier would have become less. So, this is statement right or wrong? This is right. A fall in cash reserve ratio raises the theoretical money multiplier, other things remaining constant. Why? Because it is inversely proportional. Then, second question, second point. An increase in SLR directly enlarges M1 because banks must hold more government securities. Again, this is a wrong statement, although this and this is correct, but this is wrong. Okay, but this is wrong. So, why? Because SLR is also a part of reserve ratio. Then see, even if the CRR were reduced to 0, the money multiplier would still be finite so long as the public's currency to deposit ratio remains positive, which is perfectly correct. So, 1 and 3 do we have? We have 1 and 3. Then see, last question for the day. Retail's RBI's ongoing pilots with CBDC have following immediate balance sheet effects. What is CBDC, guys? CBDC, you understand as cash in your wallet. And where is the wallet? The wallet is in digital form. So since this is in digital form, tell me this one thing, will CBDC pay you any interest? If you keep money in UPI and if you keep money in CBDC, which one will pay you interest? The money in UPI, because cash in your pocket does not pay you any interest. Similarly, CBDC will not pay you any interest. Now, let's come back. So, when RBI transfers wholesale CBDC tokens to banks in exchange for government securities, essentially cash, M0 reserve money rises, but M3 remains unchanged at the moment of transfer. क्या होना चाहिए? What should be the answer? थोड़ा सा शांति से सोचिए. Give it a minute. Cash is with the banks, so M0 is definitely increasing, but M3 remains unchanged at the moment of transfer since deposits remain unchanged. That is why this is a correct statement. Next, retail CBDC held directly with the public would be classified as currency with the public. Yes or no? Yes. Why? Because it is directly cash in your digital wallet. Then, because CBDC is a direct liability of RBI, why? M0. Its introduction eliminates the need for cash reserve ratio. Does it eliminate? It does not eliminate. M0, cash, this liquidity management tool will still be required. So, 1 and 2 only. I hope you got these questions, and I hope with this you would have known at least a little about M1, M2, M3, M4, and I hope this session was useful for you, and we'll meet in some other session. Thank you so much, guys.